What's up, everyone? Today, I'm joined by Steve Betterton and Gavin Garay. They are mortgage lenders. We talk about the market, interest rates, and everything that's going on in the market today. I'm Jake Garay from the Garay-Mashaw team with Berkshire Hathaway, and you're listening to my podcast, Selling the Suburbs. I'm sitting down with real estate agents, investors, experts, and various professionals throughout the industry. On Selling the Suburbs, we're discussing the truth about real estate, entrepreneurship, and the ever-changing housing market. Well, thank you guys for coming. I appreciate you guys taking the time. I know it's busy, but just so that for people who don't know who each of you are, kind of tell us, Steve, we'll start with you, your story, how you got in the business. How long have you been in the business now?
23 years now.
Okay, so how'd you get started?
So I started my career with the Real Estate Showcase, which was a division of Cablevision. And early on in my career, I would go around door knocking with realtors and introducing myself, and I would go out, take pictures of properties. I would come back to the office. We would go ahead and create marketing and data for them and present it on the Real Estate Showcase. It was its own designated channel.
It was like a show?
It was a show, and it would live stream all day, and it would just be repetitive, house, price, and it would just continue to go through. So kind of built my business going knocking on doors, right? Cold calling, hearing a lot of no's and overcoming objections and finally getting some yeses, and created something pretty special. And I did that for about 4 years, and then graduated from that to, it was an event, it was a networking event. And I ran into a mortgage banker by the name of Kurt Drexler. And he said, I think you'd be really good at this business. And I didn't know anything about mortgages. I just had a lot of real estate contacts. So lo and behold, gave it a try with him. Liked the business, didn't like the outlet or the channel that we were working through. And lo and behold, got a call from Lorraine Lander over at Wells Fargo. And she said, give me a shot before you get out of the business, because I was really teetering between, sticking with what I was doing or going back into the construction world and being a taper or painter, whatever it was going to be. And lo and behold, so I was with them, Wells Fargo, for about 15 years. And that was pretty much the intro into the business. And she taught me a lot of what I know today and what I've been trying to teach Gavin. And she showed me the ways and fell in love with the business. And here I am, 22 years later.
Now, did you ever consider becoming an agent or anything like that? What drew you to mortgages over everything else?
It's just you kind of fall in line. And for me, I just kind of got into a rhythm with it, and I got comfortable with it, and I enjoyed the interactions with the clients. I enjoyed working with the realtors. I never really saw myself as being a realtor, but there was an opportunity for me. John Bordy, who's up in Highland, he actually presented me with an option to go ahead and take over his business many, many years ago. I was 23, 24 years old at the time. I didn't know how to run a business or anything like that. So I just kind of pulled back and stayed in my lane and just kind of rode this wave out.
How did you even get hooked up with the Real Estate Showcase?
Interesting story. So my mother was a babysitter daycare provider back in the day. You could have multiple kids there, and one of the kids happened, her father worked for Media One Cablevision at the time, and I was on disability. I was in construction, fell off a roof, herniated some discs. I was laid up for about a year. I was on unemployment and workers' comp. I was watching soap operas during the day, and right now, if I go home and watch a soap opera, I start getting the sweats, and I got to get the hell out of the house. But so Art Heller was his name, and he said, I think you'd be really good. You have a great personality, great sense of humor. Why don't you come interview for us? And that was my intro into Cablevision and the Real Estate Showcase. And they were like, here you go. This is what you need to do, and go make it happen, kid. Gave you a little pat on the back, and that was it. It was on me to go out there and make something of myself, which, it worked out.
It's so funny because you talk to so many people that are in the business, whether it's mortgages, agents, whatever, and it's kind of like nobody sets out to get into this industry, but somehow always ends up here. And, a good portion of people obviously stick it out and spend a long time here. Mm-hmm. But Gavin, how did you get, for people who don't know, how did you become a mortgage, a lender, and how'd you get in the business?
Yeah, so obviously we grew up together. But
really? This is news to me.
Obviously we grew up around real estate. Dad was a builder, would flip houses, owned rental properties. Obviously my main focus was always on baseball and hockey, and then once I was in high school, it was really just baseball. And then obviously 2017 got drafted by the Mets, and then 2021 came around right when peak COVID. There was no season. Got a call from the Mets that I was being released. And at that point, I was like, shit, what do I do now? And then from there on, obviously I got into the investing side of real estate and doing some stuff on the wholesaling end and being involved in dad's projects and whatnot. And then a buddy of ours approached me and was like, hey, you should consider becoming a mortgage loan officer. Think it's something you'd be great at. You have the personality for it and the drive. Got into it. It was kind of the same thing. Didn't really have the support that I needed. And then obviously, fast forward to March of this year, got linked up with Steve. Randomly, we had a tea time together. Got talking more, and I thought it would be a great fit. And the past 6 months have been great.
Longer than 6 months now.
Yeah. 9 months now, but yeah, it's been great.
The rest is history.
It's amazing how the universe works, right? Because what did we do? I think you were posting out this awesome content. I reached out to you, said if there's anything I could ever do for you or your clients, and your brother totally ghosted me. So
That's loyalty there.
Yeah, it truly is. And then the next day, it was the very next day, right?
Yep.
We're at the Realtor event. I think it was Fuel on it in Fishkill. And then I see you come up, say hi, and I'm like, who the heck's this big guy? And sure enough, he's like, oh, I'm like, that's why you didn't call me.
Yeah, and then we just happened to have the tea time together.
Tea time the next day, yep. Smoking some cigars, having some fun.
There you go.
Watching him hit the long ball.
Yeah, yep.
That's why I wanted to recruit you, because I want you to teach me how to hit it.
It's just so that you could go all around to all the scrambles in the area.
Exactly.
So, Steve, in the beginning, because I know, Gavin and I both with the background in investment, I think fundamentally I built my business a lot around investors in the beginning. I know Gavin's done that a lot. When you got started, you were a younger guy. The old thing in real estate is like call your sphere, right? Like friends, family, not a lot of people. Now, I mean, maybe it was a little bit different back then, but even then, I don't think a lot of people in their, early and mid 20s were buying houses. So like, how did you build your business? What's some of the advice that you have for someone who is new and is looking to build business? Because obviously the way of doing business has changed significantly.
It has. The one compliment I received early on from the realtor I was trying to do business with for years. And she finally gave me an opportunity. And she said, I'm giving you an opportunity because you've been persistent, but you're not insistent. And nobody wants somebody that's needy, overbearing, and just bothering the hell out of somebody. So I always kind of took a little bit of a different approach and worked hard on knowing the products, programs, and being able to price loans so that if an opportunity arose that fell apart someplace else, being able to put that deal back on track. Because, as Gavin, he's young. I was young when I got into this business. There's more seasoned people than me. Why am I going to go with a 25-year-old when I can go with the 45-year-old that's been in the business forever? What do you know? What can you do differently? And, honestly, there's so many people that are in this business to this day that still don't know the things that they should know. If a deal falls off the track, you should have a backup plan. And I always had a backup plan. So when I would say yes, I meant yes. And the realtors over time became aware of that, comfortable with that, and they knew that if I said yes to a transaction, it was going to close. So that really helped me pave the way and just make a name for myself. Saying yes when others say no was like kind of my catch and my motto. And it's definitely helped me.
And I know for you guys, just in my conversation with Gavins, it's a little bit of a different approach because realtors are kind of like the first step in the process most of the time. Sometimes we'll get buyers and clients will come to us who have been pre-approved and have spoken to you first, but it's either we're first or you're first, right? I mean, that's kind of where the process starts. So a lot of what you do is having like referral partners that you can speak with. And so for us, we don't really have that, right? Like we're direct to the consumer. So that's like one of the big distinctions between what we do and what you do. But how much of your business would you say comes down to, because you mentioned like some of the other people, they don't necessarily even being in the business for this long, don't know some of the things that they should know.
Sure.
How much of it is like knowledge on the actual mortgage products, situationally, all of that? And how much of is it like just service, right? So ability to pick up the phone, be available when they need it. Because I know a lot of people who say, oh yeah, I can't get my loan officer on the phone for 3 or 4 days. We're trying to make an offer. We want to verify certain things. Like, how much of is it the experience and the knowledge, and how much is your ability to just be there and make sure? Because that's one of the things I love about working with you guys is if I give my clients your contact information, you're going to answer the phone when they call. And I can't say that about every single person.
No doubt.
So what do you think? Like, what are your thoughts on that?
Definitely service is paramount for any business out there, right? So we have to take that upon ourselves to, deliver exceptional service. And that was one of Prime Lending's core values, service beyond expectation. And if a phone rings, I'm picking it up. If an email comes in, I'm responding, and I'm doing that instantaneously, as fast as I can. If I can't get back to it in a minute, it's done within 10 minutes. Because I know that there's other people out there that are rolling over right now in this market that are giving up instead of doing what they need to do and plowing through and just coming out on the other side so that they can achieve the success that's going to be waiting for them. It's hard times right now, but the hard times make better times when the good times present themselves. So, service is definitely key and paramount. Knowing that if you are going to say yes to a transaction, that you're going to be able to close it. If you come up against an issue on a file, having that open line of communication with a business partner, letting them know what's going on. And if you're changing courses, let them know that you're changing courses. Just communication is key. So it ties back to service. I can't stress and express that enough. And then knowing your product scope, your guidelines. Here at Prime, we can go ahead and I can call Fannie Mae. I can call Freddie Mac. So if I get pushback from an underwriter, I'll call Fannie Mae and Freddie Mac directly and say, no, if you look at this, we can do this because of this. And now all of a sudden it's an aha moment for the underwriter as well. So just knowing your products, programs, pricing, and standing behind your service is definitely paramount.
And going off of that a little bit more, I remember when I was trying to buy a 2-family with the FHA loan 6-7 years ago, went through the process with the mortgage lender. Turns out they couldn't get it done after they told me the whole time that it was going to be, no issues. So then we tried to pivot, go to another lender. Same thing was told to me. Yes, we can get it done, no issues. Comes time to close, can't get it done. So when I got into this business, I knew it was going to be important to set standards with clients that, hey, if you fill out the application and you don't qualify, let me put you on the path to being able to buy a home in the next 6 months to a year, or next year, 2 years, whatever it is. And that's one of Steve's saying is a quick no is better than a long dragged out no.
Or a maybe, right?
Yeah.
Maybe we can do it. Maybe. Oh, we're trying one more thing. That's a friend of ours, Vinny, always makes the cancer diagnosis. Is like, but we're going to try one more thing. You got cancer, but we're going to try one more thing. And then the next day it's like, sorry, it's terminal. There's nothing we can do for you.
Yeah, that's the last thing.
Right.
Yeah.
What is going to the simplest, the simplest form? Because I think a lot of people don't really understand the mortgage business at all, whether it's agents, whether it's the consumer, whatever it may be. For example, what's the difference for people who don't know of a lender, direct lender versus say a mortgage broker? Because you'll hear people that say, oh, I'm talking to my mortgage broker. They're talking to a direct lender. What are the differences for people who don't understand that distinction?
So direct lender, so we'll go to the big boys. So we'll say Wells or Chase or Bank of America. They kind of tend to have a hybrid guideline, and it's based on Fannie Mae and Freddie Mac. And then they kind of have to just use whatever that bucket of products are. Pretty kind of got to be a paper, cut and dry, kind of at the mercy of the underwriter. So you're not really going to have a lot of control. You're not going to have a lot of say on your transactions. It kind of is what it is in that world. So when you step into the broker world, then you're going to have 20, 30 different outlets that you could put a transaction through. Maybe you don't have as much control, again, because you're at the mercy of what they're going to say and what they're going to come back with. Then you have a hybrid company like Prime, where we are a banker. We can go directly to Fannie Mae or Freddie Mac, FHA, USDA, VA, and we can take whatever guideline we need that's going to best suit our clients' needs. Meaning, if you're self-employed, we know that if you're self-employed for greater than 5 years, Freddie Mac is cool with 1 year of tax returns. Fannie Mae sometimes is fine with 1 year of tax return. So we kind of know the products, we know the scope of business that we're working with, we know how to put things into the system to see who's going to be more favorable for the client. So we're kind of a hybrid in between a broker and a direct lender. Even though we are a direct lender, we just have a little more freedom and flexibility.
And Gavin, what would you say coming from where you were with only a broker? Like, what's the experience that you're having now with like that hybrid versus a broker?
Yeah, I think the big thing that is an advantage for us at Prime is we have all the same underwriters looking over our files. So it's very easy for us to get on the phone with underwriters, address issues that do come up and get them cleared. Now, the broker model obviously leads to more non-QM products, whether it's DSCR investor stuff or bank statement loans, P&L stuff. But that's what another benefit that we have is we offer all those same programs and are able to do them, even though they don't have the most favorable terms. But if you're not showing money on your tax return, sometimes you don't really have another option.
So you guys are kind of taking all the different options and tailoring it to the consumer.
Yeah.
Whereas when you go with like a big bank, like a, Chase or Wells Fargo or something like that, it's like, it is what it is. There's no real flexibility there, right?
Yeah, and a lot of times with those big banks is they'll go off of Fannie and Freddie Mac, but then they'll have their own overlays. So they might not allow them to go to a 50 back end on a Fannie Mae conventional deal, where we always can, as long as the system is approving it.
And so for people who don't know, like an overlay is basically another requirement,
Yes.
right? So they're basically saying these are like Fannie Mae and Freddie Mac require this, and we're requiring this in addition to that.
Yeah. So it's, and during COVID times, and go back to the housing bubble from 07, 06 to 08, there was a lot of buybacks that the big banks had to deal with. So I know that Wells was sued for billions and billions of dollars. So what they did was, yes, we'll take these guidelines, but then we're going to put additional checks and balances in place to cover us, to protect ourselves.
So basically they're protecting themselves against recourse.
Yeah.
And what's like, so for a buyback, how long does it have, like what are the requirements for the bank to be required to have to buy back the loan?
Well, if it's not performing, typically if you close, which we haven't seen in a long period of time, but go back to those days, 06 through 07, 08, where people were making $30,000 a year, qualifying for a $3,000 a month payment. 6 months later, they weren't able to go ahead and afford their home, mailing their keys back. So, 3 to 6 months is when they start to monitor. You're behind on your payments. Why are you behind on your payments? Pull your 4506T tax transcript, which was not required when it was underwritten originally. So somebody would state on their application that they made $100,000. 4506T comes back to show why are you now defaulting. Now the 4506T, their tax transcript shows they were only making $30,000, and now it's an aha moment. So it was a loan that never should have been written.
They would ask to see it once you already own the house, but not to buy the house.
Right.
I mean, prior to 2008, you'd hear stories of loan officers and mortgage brokers that probably aren't even around in the business anymore that would get on the phone with the client. Hey, you need to make 75 grand to qualify for this loan. How much do you make? Client goes, 76,000. Okay, here's your money.
It was tough times. So living through it, you're kind of on the other side, and you look back now. You ever see the movie The Big Short?
Yeah.
Right. And you see those guys high-fiving down in Miami because they're making bank. And the problem is that it was a government initiative that came out. It was trying to make homes more accessible for buyers. And what they did was they put these systems in place through Fannie Mae and Freddie Mac. So I was telling Gavin a story the other day. I would literally take an application for you on a Monday. I would run it through the system, and it would say straight to close. And that meant that all we needed was your title report and your appraisal. And the title and appraisal would be in by Wednesday of that week, and we would close you on Friday. That's how crazy it was during those times.
So, and how often were you seeing, because prices were rising, appraisal issues?
It wasn't really an issue. And so now mini panels have been established, checks and balances are in place. Certain appraiser, everybody's licensed through the state. Back in the day, it was the wild, wild west. And, you could call the appraiser, and the appraiser would go on out, and what do you need? And they would go ahead and do what they had to do and submit an appraisal report, and you would literally close on a Friday. So it would be a 1 week transaction as opposed to what we're seeing now, which is going to be 7, 8, 10 weeks, start to finish.
So for people, because we face this, and I don't know how often you guys face this, but we face this a lot with clients, where we're out looking at properties and, they're seeing a bunch of stuff, especially the buyers who have been looking for a year plus, right? And they'll just say like, oh, this is overpriced. I saw this, it's not worth this. Everything's overpriced. It's a bubble. And then hearing, what you're talking about, which were all things that would create a bubble, because obviously you didn't care what you paid for the house because you didn't have to qualify for the house, and you just thought that you would sell the house and that would be the end of it. What do you see as the biggest differences between the market now after we've gone up, 40% in 3 years versus which prices rose 30, 40% in 3 or 4 years? Like, what are the big differences back then versus now as someone who went through that?
It was different times, right? So it was absolutely the wild, wild west. And I'll never forget going into a gas station, talking to somebody that worked there, and they were telling me they were buying a $400,000 house. And it was like, at that moment, I was like, oh my God, what an aha moment. Because that person most likely did not qualify for that home. But, you had all these banks competing for business. We had business partners attached to it. And if you weren't doing a transaction, well, you go 2 doors down to the next bank,
competition,
and they would do it, right? So now checks and balances have been put in place. The Dodd-Frank bill came out and it put in what's called the ability to repay. And the ability to repay was looking at files a little bit differently, a little more restrictive, and they wanted your debt to income ratios to be below 45%. So how much is your payment going to be? How much is your outstanding debt? They wanted that back.
What was it before that?
It really didn't matter because, like Gavin's point, what he had said before, people would say you need to make $76,000 and that would get them in underneath it. So everything was kind of a stated income mortgage back in the day because the system itself was so loose and free to where it would give you a straight to close or a streamline where you only needed an appraisal or maybe one pay stub or just one bank statement. So it was very, very easy back in the day, comparatively speaking, to the way that it is now. So the checks and balances that are in place now, everything's fully underwritten, everything's verified. All the tools that we have make sure that the people can afford their payment. So we don't want to set anybody up for failure. And in the past, that was not the case. Now we're running up against supply and demand issues, right? So we don't have enough supply, and we don't have enough supply because the majority of homes that have been purchased after 2012 until about 2021, all those interest rates are under 4%. So a lot of these people don't want to sell their property. So we have a restrictive market. And with having a restrictive market, you're going to have an increased demand, not enough supply. So it's going to push the prices up. And that's what we're seeing now.
Yeah, it's almost like, because I know at the peak of 07, I pulled the statistics. So when prices peaked in our market, we were at 23 months of inventory back in 2007, which, basically means it would take 2 years if no new inventory came on the market to sell everything. Yep. So even back then, when prices were the craziest and new construction was booming, there was more availability of homes now, 7 times plus more homes available than there are now, because right now we're at about 3 months of inventory.
Yeah.
So, in a normal healthy market is like 6 to 9 months, depending on which economist you talk to. So it's crazy to see, but it's also, to your point, and we could talk about this, like, I don't necessarily see like the dynamics changing, right? Because like, if anything, and I don't know what your opinion is, but like, I actually think that the elevated interest rates have actually helped to some degree the inventory levels, because we've seen a little bit of an accumulation of inventory the last 12 months more. Because a year ago we were at like 2 months of inventory.
Sure.
So we've seen a little bit of an increase. We're still way, way less than it should be. But I know a lot of people think that once interest rates go into the under 5, right, that people will be more likely to buy. But we have so much backlogged demand. For every one seller who will be convinced to sell because of a lower interest rate, there's 2 or 3 buyers who are going to buy their house.
Right.
So it's like we just have a shortage of housing.
Yeah.
Period. We don't have enough houses for these people in the country in general now.
No doubt.
And now it's like, the cost to build, but not just that, especially in New York and in the Northeast, the restrictions on building have made it so difficult where it could take 2 years to build one house.
Yeah. And the taxes that come along with new construction too.
Crazy.
So you buy certain areas, you go into something like Arlington or one of the surrounding areas, Rhinebeck, Beacon, whatever you're paying for the home, they're basically fully reassessing you or assessing you based on the total purchase price. So,
Right.
now you're seeing taxes that one of the great motivators for people that were in Westchester before '07 was to come up to Dutchess County because our taxes were a third of what
Right.
they were down there. Now our taxes are pretty much in line.
And in a lot of cases, I was just talking to somebody about this the other day. On a percentage basis of if you're spending, say, $700,000, you end up paying more in taxes on a $700,000 house here. Now, you obviously get a lot more for that $700,000,
Sure.
but apples to apples, we're seeing houses down in Westchester that are, say, $1.5 million that pay $28,000 a year in taxes. Whereas in Poughkeepsie, in the town, you may see $1 million house, or a $1.5 million house would pay about $60,000 a year in taxes.
It's out of control.
So it's double.
Crazy.
It's crazy. It's absolutely ludicrous. So it's now granted what you get for $1.5 million is obviously significantly more in Poughkeepsie versus in, say, Lower Westchester. That's more the median price point in a lot of towns. It's just very interesting to see. And then on top of everything, you've got all these millennials now who are entering the market that was delayed.
Yeah.
I saw something that said, I believe millennials make up, millennials and Gen X make up over 45% of the population now, or 40 to 45% of the population, but they own less than 5% of the real estate in the United States. By comparison, the baby boomers make up less than 20% and own over 50% of the real estate. So you're going to have a massive transfer of housing to those people. So it's interesting to see. I mean, I don't know, what are you guys seeing in terms of projections for next year? Obviously, the big thing the last few weeks has been rates are starting to cool off and come down. Where do you see things going next year?
I mean, just over the last 2 months, when the 10-year was almost at 5%, and now it's down under 4.2. I mean, we've definitely seen an uptick in people just wanting to get pre-approved, or people that have been looking now deciding to actually go out and make offers on stuff, just because they do see, rates are projected to come down in 2024. And as that happens, more and more buyers are going to enter the market. Every 0.5% the market dips, is a substantial amount of borrowers going out and looking to purchase homes.
What would you say are the biggest, so if someone's listening to this and they're like, I want to buy a house next year, right? Maybe it's a first-time home buyer, they've never done it before. What are each of your biggest tips for that person if they don't know anything, right? Like, this person hasn't done any research, but they see this somehow. Like, what's the best way to put yourself on the path to home ownership?
Knowing what you want your payment to be.
Yeah.
I can't tell you how many times we'll talk to somebody, get them pre-approved, and that's usually the first question I'll ask them is, how much you looking to have your mortgage payment be on a monthly basis? $1,500. All right, well, let's have a real conversation right now, because A, you're not going to find a rental for $1,500, and B, you're most likely not going to find a house that's going to offer you a payment of $1,500. Going back to some of the taxes, you might see some of the taxes be $1,500 a month. So really just knowing what your comfort zone is, what's your comfort zone and what's going to maybe make you lose a little sleep at night. Let's talk about that number, somewhere in between. So, right now what we're seeing is 1% of the loan amount is equating to, 1% of the loan amount is equating to their mortgage payment. So if somebody's taking out a $400,000 mortgage right now with the interest rates the way they are and the taxes, we're seeing that payment's coming in right around $4,000 a month. So just, clients A need to know where they want their mortgage payment to be. B, how much money do you have in the bank? And what does your credit score look like? And if it's good, great. And if it's not, talk to us sooner rather than later, because we have tools that can put these people on the path to boost their credit scores up and make them more favorable terms when the time comes for them to purchase.
Yeah, so how much does credit impact rate?
Quite a bit. So when you look at the conventional side of things, which would be Fannie Mae and Freddie Mac, they start in tiers. Everything's 20-point tiers, 620 being the minimum, all the way up to 760. 760 gets you the best of the best of the best, gets you the best rate, best PMI, and best financing options. So if somebody does not have that credit score, we'll work with them to try to enhance their credit if we can, naturally, organically. And if it's not an option, then we look at something like a FHA loan or a USDA loan, where they kind of have a blanket rate from 580 all the way up to 760. It's kind of the same rate, basically same terms, very favorable PMI, where if you have a 680 credit score on a conventional loan, your PMI might be $200 a month higher than it would be on an FHA loan. So, just kind of knowing where their scores are is super important for them, because if there's little tweaks that we can make now and make them a buyer in 6 months with a 20, 40 point higher credit score, it's going to serve them well over the life of the loan.
I think it's so. Just one question on what you said. So you said 760 or above gets the same. So is it like if you're 770 or 800, it doesn't make a difference?
You get the same. Yep.
That's interesting.
Yep.
I never knew that.
Yep. Top tier 760 used to be 740, so they're always changing it, always messing with it, but now it's 760 again.
Yeah, and I think now especially it's important for more agents on the listing side of things being okay with FHA buyers.
Huge.
I think it's a better product than I think a lot of agents out there have a false, narrative on what FHA is and the shape that the property actually has to be in.
I really don't get the FHA blowback. So many people hate FHA loans, and there's so many misconceptions with agents that will just not accept them. And I just feel like it's lazy. It's very lazy to just not do your work. And it's also, it's prohibitive to the market. I always have a conversation when I meet with every seller, whether or not the house is let's just say it's a clean house, no health or safety concerns. You want those FHA buyers because typically, like it or not, the lower qualified, let's call them buyers, are willing to make up for their lack of qualifications with a higher price.
Sure.
Right? So if you're putting 5% down, that's looked at less favorably than someone who's putting 50% down. So the person who's putting 50% down might be able to save themselves $5,000, $10,000, $15,000 on the price, depending on the seller, whereas the buyer who's putting less money down has to compensate for that with the price.
Yeah.
But, people need to understand that that's the situation that they're in, and the opportunity cost as well of not owning, right? Because when you own, look at the people. If you were looking in 2018, 2019, and you decided to put your search on hold and you never bought, you lost out on 45% appreciation in 3 or 4 years. That's, anybody who bought then can now sell their house, use that money that they earned in appreciation, roll it into a bigger home for their family or anything like that. Yep. So it's just very, like I said, I think it's very lazy for people to think that way.
And FHA is a great program. It's definitely had a funk on it. So when I first got into the business, it was the sign of the cross anytime anybody had an FHA transaction. It blows my mind even to this day that we're still seeing that. And it's a wonderful program. And it offers today a lower interest rate for the buyer than a conventional loan does.
And like you said, less PMI.
Less PMI,
less
depending
money
on
down.
credit score, less larger seller concessions, so they can roll costs to close in. FHA 203K renovation loan will give them money to buy a house and fix a house. Streamlined. There's a ton of benefits that come along with an FHA transaction.
And I remember when I got in the business, everybody was like, "Oh, it takes forever." It doesn't take any longer. It's the same exact process. It's the exact same thing. So that brings us to a good point. What are some of the biggest misconceptions that you get from buyers?
For FHA loans?
Just in general. Just people who call, what are the things that people just don't understand or misconceptions that people have when they call you?
Still to this day, 20% down is a requirement.
I hear that all the time.
All the time. It's like, where do these people live on underneath a rock? Can't believe it.
And then I also hear all the time is, hey, don't think about putting me into an FHA loan because I don't want to pay the PMI. And it's like,
well, are you putting 20% down?
Yeah.
Yeah.
And a lot of times I'll price it both ways and I'll be like, hey, your PMI is or your MIP technically in FHA is less in an FHA loan than it is on the conventional loan. And they're like, really? I'm like, yeah, and your rate's better, your payment's better. And then they're like, oh, maybe I do want to do an FHA loan.
Streamlined refinance opportunity for them. So if there is a small pullback in prices, the streamlined refi through the FHA allows them to go ahead and do exactly that, streamline their refinance. No appraisal is needed a lot of times, so they can go ahead and just use whatever the value was and refinance into the better rate, better terms, lower their payment. It's a home run. You don't have that option with conventional. They most likely will come up with something depending if the market corrects. Don't think it will, but if it did, like they did with the HARP refinances back in the day, basically Fannie Mae and Freddie Mac were like, don't worry about it. No appraisals needed. you have on-time payment history, we're going to go ahead and just let you refinance.
You're saying if rates corrected and went down?
If rates corrected, but property values went down.
Ah, I see.
Yeah.
Yeah.
Which don't really see that happening. But in the event that it did, the FHA gives you a leg up if you had to refinance in that scenario.
Other big things is definitely, I just lost my train of thought. Jeez. But a lot of borrowers calling and not, they're asking what their rate is for that day. And obviously it's hard to give somebody a blanket rate without having their exact credentials and their application.
What's the interest rate?
But exactly, that's probably one of the most
3%. Oh my God.
And
Just
then
starting the process. Get out there and find a house.
And that goes right along with that. A lot of times you'll give them the rate and they'll be like, oh, well, this bank told me 5.75. And I'm like, that's literally impossible. I'm like, give me a loan estimate, and then you never get it, and then you end up working with the client. But a lot of times people think that that we control the interest rates. They're not knowledgeable on, the Fed and the actual economics.
You mean you're not lending your own money?
Not currently.
How, you have to obviously have a nuance when you're working with people, because mortgages are very complicated. All of these different things. You could go on for a tirade about how interest rates are even set and how that works and the range. How detail oriented do you get? And obviously every client's different, but how do you know which client needs to know the true, the full extent of the story of how everything works and operates and how it's going to be sold to an investor, and there's going to be servicing with a different company? But how do you know versus just giving them the information that they need? You know what I mean?
Yeah. Every client's different, as you know. So anybody that comes in and meets with me in person, they get, pieces of paper drawn out. Everything's just kind of drafted out, and it's just case by case. And this is what's happening. This is what your payment's going to be like. This is what your closing costs are going to be like. This is what's going to happen after your mortgage. This is who it's getting sold to. Fannie, Freddie, FHA, USDA. However, we're always going to collect the payment on their behalf. So it's a little bit of a different approach because those people reached out to me directly, wanted to sit down. So I know they need a little bit more hand-holding. Being in the business for as many years as you have, and you'll get it too, and I'm sure you have it now, but your spider senses tingle. You can hear it in your ear. You can tell that they need a little more information. And you get the other people, you can just hear they're cool, calm, and collected, and that they're just going along with the process. They're comfortable with the numbers. They kind of get the gist of how everything works. So everything's kind of custom tailored to each and every client wants and needs.
Yeah, and especially first-time home buyers, trying to keep it as simple as possible in your conversations with them, because a lot of times they either have false knowledge coming into the home buying experience, maybe from a relative or a parent that might not have bought a house in 20 plus years or whatever it is. So those clients typically need more hand-holding and a little bit more guidance along the process just to keep it going smoothly.
Yeah, gone are the days you go sit in the bank and ask them what they can do for you on rate and everything else, right? You go sit with the president of the bank or something like that.
Yep. It's a Wonderful Life. I think that was that movie, right?
Yeah. It's tough because it's obviously, like I said, it's a complicated thing. But it also, if you have an understanding of how the system works, it's a lot easier. You feel a lot more comfortable inside of that system.
Yeah.
Right? For example, as you mentioned before with, home prices, what direction they're going, everything. It's if you understood, if you saw the back, behind the curtain, so to speak, in 2006, 7, and 8, and what led to that crash versus what's going on now, you'd feel much more strongly like you do that, hey, prices aren't coming down, this is what's going on, and this is why, versus someone who, like Gavin said, is a first-time home buyer who hasn't gone through that, hasn't experienced it. For someone who's in their, say, 20s, they remember what it was like to be a kid during that time and know all the parents were stressed out and every single day was financial crisis and everything else. So all you do is associate that with housing collapse, bubble, overpriced, and it's
And that's the thing too, over the last 24 months, there's been a lot of fear mongering in the media and on the news about housing pricing, housing collapse inbound and all this stuff, and, recession, and a lot of data coming out like that, especially in the media, which was scaring people from going and purchasing homes.
The only time I was fearful about a new bubble kind of creating was when the interest rates started creeping over 7. It's the only time I was a little bit worried because everybody before 2020, 2021, under 4%, right? And if you have a average payment of $2,000 to $2,400 a month, which most people do, you're going to sell your house, you're going to let that house go, or you're going to go rent. Where are you going to stay? You're not. You're not finding rent for $2,000 to $2,400 a month. Most likely that's not as nice as the property that you had. So the only concern I had was, when we see 5% down, 7.625, 8.5%, payment maybe a little unrealistic, a little bit worried for a little bit, but now that we're seeing the rates start to soften, knowing most likely that we're going to go into some sort of soft recession. Fed's talking about potential, there's cuts coming, not sure how many. Some people are thinking maybe 6. So, with that being said, we could see rates back into the high 5s, which would be a high 5 moment. And then people could refinance out of their 7.5%, 8% rate down to something more manageable. So, now that risk is kind of getting mitigated, which is great.
Yeah.
I like to see that.
Yeah. It's an interesting place for real estate to be in because it's almost inversely tied to what's going on in the economy in some ways right now, because if we go into a recession, and obviously it's supply and demand, right? So if it's a mild recession where you don't have a ton of unemployment and job cuts and everything else, that means that it's not going to really impact the demand on the demand side. So that demand's not going away.
Right.
And if we go into a recession and they start cutting rates, that makes housing more affordable. If anything, it actually might increase demand,
Sure.
which will lead to an increasing pricing. So it's almost like a mild recession with rate cuts could lead to housing prices going up.
Sure.
Similar to what we saw in like the 70s when inflation went crazy, there was economic uncertainty and home prices rose significantly over that 10-year span because of the lack of inventory and the
Sure.
demand. So it's a very unique time. And I think, my whole thing with everybody that I always speak with and, drawing the comparison to 2007 and 8 is it's like, that was the second worst housing collapse ever. The other was the Great Depression.
Yeah.
So you talk about a 75-ish year time frame between when that happened. And it's like, you really think we're going to have the third worst 12 or 13 years later? It's probably going to come at another time when
Sure.
maybe housing becomes so unaffordable that they start taking away all of these restrictions and oversight and everything else like that. Yeah. And you take away regulation, and that's when people get, a little crazy. Like it went back in 2020 and 21 when rates were at like 2.75 and 2.5. It's like you start getting into that point, people start doing crazy stuff.
Sure.
We see it on the investment side. Like I tell so many investors now, I'm like, you think you're like this sophisticated and savvy investor because you bought maybe 1 or 2 properties in 2020 or 21. And it was really, you didn't buy a good deal. You just bought good money.
Yeah.
Right? Like you just got a 2.5 or 3% interest rate on an okay deal, and the cheap money made it really good. And then on top of that, you benefited from, a 20-25% increase,
Sure.
which allowed you to maybe sell it and roll it into something else or refi or whatever the case may be. But like so many people think that they're like, the next big real estate investor,
Sure.
but just because they got cheap money.
Do it during good times, try it during bad times.
Right. Well, now.
Yeah.
Right. How many of those investors
Sure.
have bought something in the last 12 months? Zero. Because they don't know how to actually underwrite a deal and then negotiate a good deal. Because right now, the multifamily market is like the commercial multifamily market is like the one segment of the market that's dried up significantly this year. Like basically no transactions are happening. And if you are selling, you're probably a super distressed seller or you're selling to an owner occupant, right? Because an owner occupant will pay you your inflated price because they're putting less money down. They can offset the cost. It's cheaper than going and buying a single family home. Or you're a distressed seller and the property needs a total overhaul, in which case you're selling at 50 or 60 cents on the dollar anyway, and someone's going to hold that new appreciated value and purchase it. It's interesting to see.
I had a call this morning with an investor client of ours that closed on a property, I think a month or 2 ago now, and he's already talking to me about pulling cash out because of how good of a deal he got on it. And he's bought in 2 properties with inflated rates, both above 7.5, and they were both positively cash flowing at those numbers, and he'll have a chance to refinance to a lower rate and up his monthly income on those. So those are the investors that have bought with inflated rates that are doing well. They obviously are more savvy, know what they're doing, versus a lot of people standing on the sidelines because of rates, because they're like, oh, I can't get cash flow with my 25% down, but they're not looking at the right deals.
Well, and it's also like I was talking to someone who was like, I want to buy right now because I know if, let's just play this scenario out, you know, let's say nothing happens, rates don't increase. Well, then the pricing in market's going to probably just status quo, right? Nothing is really going to impact prices. They may go up 1 or 2%, but it's going to basically be status quo if rates stay around 7%. He's like, but if we do start to see rate cuts, then all of a sudden, you know, if I buy something at today's pricing, we might see a 10 or 15% jump over the next 18 months in those assets. So I'd rather buy today and not have to compete against all the other people who are going to re-enter the market because now the money's cheap again. You know, you said if you start getting into the fives again, all of a sudden it's like, that's a pretty standard investment property interest rate.
Right.
I was trying to tell people back, you know, in 2020 and 21, they're like, oh, you know, the rates on commercial loans are, it's 4.5% and my mortgage is 2.9. I'm like, 4.5% on a 30-year fixed on a commercial loan. Like, you don't understand.
It's phenomenal.
How good that is. Like, you know, and people also forget that back in 2019, rates were, I had clients buying single families owner occupant with conventional loans at 4.8, 4.9%. Sure. You know, people had like amnesia and forgot that they just saw 2.5, 2.75, 3%. And all of a sudden.
Spoiled. A lot of people got spoiled.
I mean, it's funny because just over the last few weeks when rates have started creeping back into the high sixes, low sevens, I locked somebody last week in the high sixes and I was like high-fiving Steve in the office like, yeah.
Yeah, you told me you locked someone at like 6.75 with 1 point, right?
Yeah.
I was like, oh my gosh.
Yeah, here we go.
That's like, that's not bad.
Not bad.
But that's what we're saying now where, you know.
It's a half point less than what I got on my mortgage that I got this year.
18 months ago.
Time to refi.
18 months ago, we were all like, oh, this is terrible.
Yeah.
And now 6.75 sounds pretty good.
I think, you know, we've seen now after 15, 16 months of kind of that rate hike environment, right? Which was like beginning of Q3 22 through the end of this year, that the market can absorb, they can absorb as high as say 7.5% and nothing change. But the market will actually grow pricing wise, anything sub 7.
Yeah.
We saw it in the spring, bidding wars, 30, 40, 50,000 over asking price, at least in the Northeast. And our lead economists have said that basically the Northeast can absorb, you know, a 4x increase of inventory without any impact on pricing. Wow. Now it's different here than it say is in Southern Florida or in Texas or the Carolinas, Tennessee, Nevada, because they have large swaths of land that they're just building hundreds and hundreds and thousands of homes. So some of those markets are different, but people who are listening to this, I think, see like, say, CNN, Fox News, you know, MSNBC, and they see the headlines that apply to a national audience and think that that's applicable to their little town here in New York. And in reality, what's going on in New York versus what is being advertised nationally in, say, Texas or Florida is completely different.
Totally different. Yeah, every market's different. Every market's unique, for sure.
I saw something today that was from Bigger Pockets talking about how foreclosures are up 9% year over year. And it's just so ironic because when you look at it at a 10-year scale, this is the second lowest year of foreclosures ever compared to last year.
Sure. And then what's that 9% based on? Was it 1,000 foreclosures and now it's, you know, 109 or 1,010?
I saw last year was like 200.
I'm better with a calculator in my hand. But what's that number, you know? So it's like, what is it?
I saw last year, I think there was like 240 or 250,000 foreclosures in the U.S. In the height of the housing bubble, it was like 1.6 million, and that happened like 6 years in a row.
Got it.
So it's like, let's have some context to this conversation.
And also it's kind of, I guess, false in a way, just because in 2021, there was no foreclosures happening because of the
that's the other thing.
The government.
That was last year when they were like, oh, foreclosures are up 100% year over year.
Yeah,
and it's
like, they are.
Of course.
One is 100% more than zero.
Exactly.
It's ridiculous. So it's a lot of, you know, I feel like the real estate industry as a whole in the market, especially here in the Northeast, is like there's so many misconceptions. And I've been harping on this to my team like religiously, because I think there's a lot more buyers and sellers out there who are not actively in the market because of those misconceptions, because they don't understand what's actually going on. And so many times, I'd say at least 70% of the listing appointments I've gone on this year, we've sat down with the sellers and we were like, it's a great time to sell. Your price is up 3% this year. Inventory is very low. There's no competition. Bidding wars are still happening. And they're like, what? That is not what we've been hearing whatsoever. Like, that's a completely different story. We thought it was a terrible time to sell. We thought the market was crappy. And we had people who put their house on in a week or two that were going to wait 6 months, 9 months, a year because they thought it was a bad market.
And sold right away.
Sold right away.
Yep.
For, in a lot of times, a premium over what we even thought we would get.
Which is beautiful.
It's great for a seller because I always say it's like at the basis, it's like every buyer, which you guys are dealing with, or every seller, at the end of the day, people don't really care what the overall market's doing. They just care how it impacts their wallet.
Sure. We watch the news every day. I'm listening to, podcasts. And the one thing I'll say is when you look at Google and you do just regular search and you want to just see what's going on with the market, your local market, interest rates, seems like it's always a week to 2 delayed. Like when we were creeping up to 8, and then all of a sudden we pulled back to 7.5. And what's the news say 3-4 days later, rates hit 8%. Yeah, but that was a week ago.
Yep.
We're not 8% today. Everything changes on the daily. You got to pay attention a little bit more and don't sit on the sidelines because of what you're reading, because most likely it's not true.
I saw another Bigger Pockets post that did that exact same thing. They were like, interest rates hit 8%. I'm just going to hit on Bigger Pockets because they're pissing me off with their
canceling Bigger Pockets.
They're driving me crazy with like their fear mongering. But like they posted something on Instagram, it was a graphic. It was like mortgage rates hit 8%. And it was 6 weeks after that.
Yeah.
And rates were back down to like 7.3. And every single comment was like, yeah, a month and a half ago.
Yeah.
At least people called them out on it.
Yeah. Well, it was all the realtors who were like, what the hell?
That was like 2 weeks ago. And
I know.
It was when the 10-year went on that rally where it was just coming down like crazy amount in 3 days.
It was in the middle of like rates plummeting. Like,
But what do we know? Bad news sells, right? And
the problem.
the bad news, 8% versus the good news of 7%. It's like, no, spin the 7. It's good news. It's positive. But no, they got to put out the 8.
It's all the internet gurus that are like, oh, this is a great headline. If you want to learn how to make money in real estate investing at 8% interest rates, buy my course for $1,000.
well, it's like they focus on selling the two things, right? Fear and greed. If you see a stock go up 25%, like the meme rally, everybody wants to jump in.
Fear of missing out.
Fear of missing out and the greed, or the fear of losing everything. Bitcoin goes down 50% and everybody's fear selling and everything else like that. You see the extremes. A buddy of mine always says, you never wake up and you turn on the news and they say the sun is out, everything's fine, go back to bed, everything's all right. That never happens.
Hopefully one day. That would be lovely.
Yeah, maybe if you ever end up in like a simulation or something, that's probably your only chance.
We could be there already. Who knows?
We could be.
We're about to go.
Podcast for another time.
That's episode 2.
That's the one with some cocktails.
Yeah.
There you go. Sure. There you go. So for anybody who's listening, wants to connect with you guys, what's the best way to find you guys? Social media, what's the best way to connect?
Probably social media or just find me through Instagram. Probably the best way to reach out to me.
Cool.
Yeah. And for me, social media as well. Instagram, Facebook, and then, just Google me. Hopefully I'll pop up first for any other Steve Betterton out there.
I didn't know you were your career started as a budding television star.
Yeah.
And look, it's come full circle. Now you're back on camera. So thank you guys for coming. I really appreciate you guys taking the time, and we'll have to do it again soon.
Awesome. Yeah. Appreciate it.
Thanks for having us.
Cool.